Hello and welcome to my morning notes back in London this week. Let's take a look at the troubled relationship between the US and China. It's been a flashpoint for the world economy at least since President Nixon went to visit Chairman Mao all those years ago. But at the moment, it could be a relationship that is in the throes of changing. We hear a lot about the great rotation from bonds to stocks, but maybe what we're about to see is a great rotation from east to west. With me now to discuss this very grand, very interesting hypothesis is the CEO of Longview Economics here in London, Chris Watling. Chris, thanks for being here today.
Pleasure. Yeah.
Now, as I understand your hypothesis, what you're saying is that the US really is showing signs of recovery, and we have one chart adapted from your research to show this. Where are those green shoots in the US?
Yeah, I mean, we've seen some good pickup in some key cyclical areas of the economy in recent years in the States. In housing in particular, we've seen a key turn about 12, 18 months ago.
And shown in the green line there. Right.
Seen in the green line, you see housing starts and permits are in a clear uptrend, and really as rapidly as they've been in other recoveries once they get going. Cars are in a good shape, and other parts of the economy are healed. So the state and local budgets are largely healed and consolidated. We see the banks starting to lend, and of course this great energy revolution in the States, which is giving them cheap energy and leading to a resurgence of manufacturing jobs, is all adding at the margin. So, we see an increasingly resurgent U.S. economy, not as strong as the second half of the 90s, but increasingly improving.
So at least there's reason for capital to flow to the west. Let's start looking at the reasons to worry about the east. Now this shows how much credit needs to grow in China to push growth. Take us through this. This looks a little alarming at first sight.
Yeah, so here we have credit intensity of growth. So how much they have to borrow for every sort of renminbi of GDP growth. And clearly if you're going at about 1 times, that's fine, or a little bit over 1's not really anything to worry about too seriously.
Which is what was the case for much of the last decade.
Exactly, the case up to 2008. And then of course in 2009 we had the great credit splurge, the great credit stimulus to get China going again. And really what we see since 2009 is that ratios remain too high, and it was high again in 2012, expected to be high in 2013. So it's really telling us the structure of Chinese growth is not good, too much borrowing to get the economy moving.
And is there an asset bubble? We're now going to take a look at land prices. This is a fascinating comparison between British land prices, which we can all agree are expensive, and Chinese.
Yeah, so what we've done, I mean, Kindleberger talks about bubbles and expensive asset valuations is part of his thesis, and here you see that actually average land prices in China, land with planning permissions, about $2 million an acre is the top chart, and in the UK now we're at about $1.7 million per acre. And actually, if you look at some of the more frothy parts of eastern China, commercial at 11 and residential at 7, you're pretty much where London was at the peak in 2008.
Which is startling, because obviously there's far greater supply of land in eastern China than there is here in London.
Yeah, and we're a much wealthier economy in Britain. It may not be a very good economy, but it's a lot wealthier. So there's more capacity to pay that sort of price.
So what does this mean in terms of asset allocation? What it seems you're suggesting is that China is in danger of a very drastic slowdown, maybe not imminently, but in the next year or two. How do you express that as an investment?
Yeah, that's right. We think there's a credit bubble that could burst in China, or could at least deflate quite significantly. And of course China feeds into emerging markets. It's a great driver of many emerging markets, particularly in Asia, but further afield in Brazil as well. So for the first time in several years we've moved to a greater weighting in developed market equities than emerging market equities, and we're starting to pull down the emerging market equity weighting and push up the developed markets. So part of that trend, capital returning back to the West from the East. Maybe only for a couple of years, but clearly while China cleans up its problems, that I think is going to be a key driver.
Okay, Chris, thank you very much indeed. I think that's a very clear steer on asset allocation, at least for the time being. Expect the developed world to keep outperforming, and I'd add perhaps also expect industrial metals, not just gold, to keep underperforming for a while.